The Indian economy slowed further in the July to September quarter. Consumption remained weak. Investment actually contracted on a year-on-year basis. GDP growth came in at 4.5%. GVA growth came in at 4.3%. Nominal growth on a GDP basis was at just 6.1%. Let's get straight into analysis with our panel of experts to understand what these numbers are telling us about the economy. Kaushik, Director and Chief India Economist at Deutsche Bank, is with us. Rahul Bajoria, Chief India Economist at Barclays, is with us. And we are also joined by Siddhartha Sanyal, Chief Economist at Bandhan Bank. Let's get started. Lots to talk about. Kaushik, let me come straight to you. The headline number, what did you make of it? I know it was in line with the consensus numbers, but if you can talk a little bit about the real and the nominal GDP numbers and what you made of them.
Yeah, so we had a forecast of 4.5 and, we've got that number, but it's nothing to be, cheerful about. India's potential growth rate, as you know, is about 6.5 to 7%. So we are growing at 4.5, 5% in the last 2 quarters. And going forward also, it's clear that the recovery is going to be shallow. So it's not like, growth would jump back to 6.5% anytime soon. So probably this year at best, we will achieve 5% average growth, which is going to come down from 6.8, which is not good at all. A few positive things, what I saw in the details, is that private consumption growth, which was 3% YOY in the previous quarter, has improved to 5.1%. It's still much lower than that 7-8% that we used to have, but at least there has been some traction. But the bad news is that investment growth has fallen to about 1% YOY, which is very, very low. And, so that's a source of concern. Now, obviously, government consumption helped a lot. Government has been front-loading expenditure in July, September. My guess is that they'll do the same in October, December as well. So probably October, December GDP, again, you'll get in the range of 4.5 to 5%. And then January, March, when there's a positive base, and then the next few quarters when there's a positive base, you'd see some traction. Nominal GDP growth at 6% is a big worry, because what will happen is your debt GDP will start, flattening out and then probably increase as well. So we are already at 69-70% debt GDP. So people who are advocating fiscal deficit to be, allowed to go up should be taking that into consideration as well.
All right, Kaushik, I'll come to some of these individual points in a minute. Let me go across to Rahul. Rahul, your thoughts? You're focusing on GDP ex government as well, as one should, given the sharp increase in government expenditure this quarter.
Yeah, so this particular quarter, we saw the government GDP, GDP ex-government and ex-farm sector decline to about 3.2%. Now, this is the weakest number in almost a decade. It was quite clear that the private sector, both from a consumption and from an investment perspective, was showing signs of a lot of stress, and that's kind of come through in the numbers. Having said that, we do see some signs of aggregate demand starting to stabilize. Our sense is that the third quarter and the fourth quarter numbers for the fiscal year are going to be marginally better, and you will see even sequentially growth is starting to show some signs of improvement. So I would say this particular print was reasonably well telegraphed. Market was expecting a poor print. And we have not had a very shocking outcome. So, being close to consensus is a good outcome. In that particular regards, it would be interesting to see what's the trajectory of growth that the RBI lays out for next week, and that probably will give a lot of cue to the market about the scope for further policy support, both from a monetary and from a fiscal perspective.
All right, and I'll get to that in a minute. Siddharth, this issue of meeting expectations is a fabulous thing, right? I mean, yes, at 4.5, we met expectations, but this is now the 6th quarter of decline, and we've come off growth rates starting at 8%, a little above 8%, and we're at 4.5 now.
Indeed, it's clearly stunning. 5 quarters back, growth number was at around 8%. Today, it's at around 4.5%. But it is still, I think, the way you mentioned rightly, I think it makes a lot of sense also that this is, if you see in the last 2 quarters, there had been significant and sizable disappointment in terms of expectation and actual outcome. I think at this moment, given that the 4.5% number which we are seeing today is in line with market expectation, is also one important factor that at this moment, the actual prints are getting better aligned with the high frequency indicators. To that extent, it's positive. The other factor is that there was a big negative in the last quarterly print when the consumption, private final consumption expenditure growth rate, which is very clearly the mainstay of growth in case of the Indian economy, had registered a sharp fall from the usual 7% odd handle to a much lower number. It seems to be the case that that particular number is stabilizing at a slightly better or slightly more respectable zone, still a bit weak, but it's stabilizing at a slightly better number, better zone, which is a clear positive.
Okay. Kaushik, can I just ask you for a little bit more clarity on the nominal numbers and the role that the deflators have played in keeping real GDP at 4.5%? These deflators link up to the WPI, so it's not surprising that they are lower this quarter?
Yeah, so, they give a disproportionate weight to WPI, and therefore, compared to the CPI, whatever the average was for July, September, the deflator would be lower if the WPI is, very low. So this is a problem, and I don't know how, this needs to be taken care of, because if RBI is targeting inflation, CPI should have a higher weight in the GDP deflator, but we've been following this model for a long time. So anyway, we have nominal GDP growth at 6%, and I'm not saying nominal GDP will stabilize at 6%. It should go up close to 8.5%, 9% this year. But whenever nominal GDP growth is lower than your nominal interest rate, say 10-year bond is at 6.5, you'll have debt GDP kind of increasing. So that's a source of concern, and we have done this study where we've seen that India's debt sustainability hinges mostly on having a good quality and high growth. And nominal GDP growth typically in India has been much higher than the nominal interest rate, or real growth has been higher than the real interest rate. So if that metric doesn't work out, then you'll have debt GDP kind of first flattening out and then starting to rise, which is the case in many advanced countries. So in India's case, we don't see that scenario. We see nominal GDP growth slowly increasing to close to 8.5%, 9%. But remember that the government has taken close to 11.5%, 12% growth for its fiscal calculations. So from that standpoint, if you assume a 9% growth, there would be some shortfall in the fiscal, even if all the numbers are kept constant.
Yeah, that's absolutely true. Rahul, also, this level of nominal GDP growth, 8% last quarter, 6.1% now, explains why there's all this gloom and doom in the industry as well, right, among corporates, because at the end of the day, that is what matters to them most.
Yeah, so absolutely. I think the top line revenue growth has been quite weak, and if we look at the sources of where this top line revenue growth is coming from, it's largely centered in areas like agriculture. We have seen a bit of a pickup in places in certain services, and certain sectors like financial sector is reporting growth close to around 6%, but we know that this particular sector is going through some stress as well, and so some of the numbers don't really make a lot of sense, but at the same time, I would say at the aggregate level, when you have nominal GDP growth at around 6%, it is going to create a lot of pain, and this actually gels up well with the data that RBI had put out earlier about flow of funds themselves being negative year on year, negative from a year-to-date perspective, and probably kind of reflects the kind of pain that's kind of come through from a working capital perspective, and also hopefully going forward in the next 6 months, we are going to see these conditions normalize, and that in itself should help nominal GDP growth improve at the margin.
Slightly peripheral issue, Siddharth, if I can just round up this conversation and then come to some of the other components. There's been this sort of underlying buzz that's been picking up as to whether we picked an inflation target which was too low and whether India needs higher inflation. I know that's not directly relevant to this conversation, but I'm drawing a link between the low nominal GDP and the fact that we've been in a period where real growth has been low, inflation has been low. So in some ways, you haven't really seen any benefit from what was supposed to be a positive, low inflation.
I think low inflation in the Indian context is clearly positive. And remember, if you go back to the previous last time when we had hit this kind of a growth rate, way back in 2013, at that point of time, the CPI numbers used to be in close to double digits, if not in double digits. Compared to that, given that we are at a low inflation zone at this moment, it gives a lot of comfort to policymakers, no doubt about that. Having said that, given that India's long-term CPI average is slightly higher than what we are seeing now, so if India's long-term CPI average had been close to 7% and the current number is more in the 3% handle, in 2021, when we come closer to review the inflation targeting mandate once again, I'm pretty sure this particular discussion will come up, make some bit of a comeback, whether we can think of, maybe not we will think of a 7%, but possibly a slightly more relaxed band or slightly more different number to target. That possibility cannot really be ruled out a couple of years down.
All right, sorry for that esoteric question in the middle of a GDP analysis. Kaushik, coming back to you on sectors now. Within the sectors, anything stood out for you as being particularly weak or better than expected? Construction or manufacturing or within the financial services space?
Even without getting into that, what we should be talking about is the problem in the NBFC sector, and unless that gets resolved, you would see the different sectors showing stress, and what we today have is a sense of risk aversion in the economy. So the credit market is not performing properly, and we know that, as Rahul mentioned, that the flow of funds from NBFCs has been negative, and and bank credit growth has also slowed down. To that extent, you would expect growth to kind of slow down substantially. So I guess the bigger issue of getting growth back on track is to get the NBFC sector kind of stabilizing, and unless you have that, RBI can continue to cut rates. There could be more liquidity in the economy, but the question is, how do you distribute that liquidity to entities who actually need that liquidity? And if you don't have confidence to give money to those people, those who need it, they are not able to on-lend then again to the last receivers of that money. So to that extent, I guess the different sectors that you are seeing, say for example construction, we know that real estate sector is in a doldrum. So what would you expect, because they're not getting money, so obviously the multiplier impact of that construction you would see on a lower side. Investment, if you see, despite government having spent, we don't have the breakup of private and government in that quarterly number, but it's just 1% YOY. There's a base effect which has played its part, because last year same quarter was 11% growth, but even then we are at 1% growth. So to that extent, I guess we need to have a bigger discussion on how to solve this NBFC sector crisis.
No, absolutely. Even from an employment perspective, Rahul, if I can come to you, I think it's been pointed out that employment-intensive sectors, whether it's manufacturing or it's construction, have now been persistently weak for a while. So, one would need some focus there as well, but it probably links up to what Kaushik is saying, at least in the case of construction.
Yeah, absolutely. I think, sectors which generate large multiplier effects across employment, across, financial sector, they have obviously been weakening, and that's been a core area of concern. What has been interesting, is the improvement in private consumption. So, before coming here, we were discussing internally about, what could be driving it, and looks like the agriculture sector still showing relatively robust growth has played some part in, kind of providing some mitigating support to a certain extent. I don't know how long does that, continue, or if that could potentially be a source of support going forward, given that weather disruptions have come off. There's been some supply concerns which were there in, say, the coal sector. They have also appear to have been addressed, and so, maybe things are not going to be that negative from a supply perspective, which will help improve the numbers at the margin. But I couldn't agree more, that some of the sectors which generate larger multiplier effects like construction have to be revived soon, and I think fiscal policy could play a big part in that, even if it's for a short period.
Siddhartha, you want to jump in on the expenditure side data? So I guess, like you started by saying, 5% is better than 3%, but it's still not. What is our long-term average? Around 7-8% we've been growing over the last few years until this downturn happened?
Yeah, that's correct. the consumption basket is close to 2/3 of the economy typically, and that typically gives us a growth rate more often than not in the 7% handle, 7 to 8%, and that typically gives the big stability that we always talk about in case of Indian GDP growth. Given that now, for a while, given that that had dropped to a 3% handle, that possibly has created a lot of uncertainty in the minds of forecasters, in the minds of policymakers, and we really need to figure out that even if the number is slightly better at this juncture, how stable or that number will be in the coming quarters, or what exactly will be the path. Given the favorable base effect, etc., which we enjoy at this moment, going ahead next few quarters, the numbers might actually look slightly better, but we really need to have a close tab on this particular number, because at this moment, given the kind of negative sentiment that is prevailing in the economy, big tailwind from the investment sector may not really be the case. So we will remain very, very dependent on some bit of government spending and some bit of revival in the consumption segment. To some extent, that's happening, but we really need to remain. We need to watch it very, very closely in the next few quarters.
All right, I'm just going to wrap up the conversation now, talking about policy actions. Kaushik, I think everybody believes that the RBI will do another cut, but equally everybody believes that it's probably not going to help in a big way, may help in the margin, once monetary policy starts filtering through the system. Do you see the government now realizing that perhaps there has to be, more fiscal action? I mean, we don't know whether they can create the room or they have the room, but at least the realization maybe?
Oh, I have a different view. I think the government would try hard to meet the fiscal deficit target, because not meeting the target could have, even more serious implication. S&P is yet to do their review. Moody's has just downgraded the outlook. And I told you that, debt GDP is not looking good. You can keep on looking at the fiscal deficit, but the real, issue is with debt GDP and, other sources because there are off-budgetary transactions which have happened. To that extent, my belief is that the government will try hard to meet the fiscal deficit target, which will give some stability to the bond market. And therefore, if RBI continues to cut rates, there would be transmission, given that RBI will also keep liquidity flush in the system. So I guess this cycle we need to depend more on monetary policy. Fiscal policy, also remember that it's not like you do some stimulus, tomorrow you'll see growth going back. It takes a lot of time for growth to kind of come back if you're doing a big infrastructure project, or if you're going down that line. Consumption, obviously government can try to spend more than what it has budgeted, but that can have negative consequences from other sources like rupee, or if you see foreign investors pulling out money from India, there could be other issues. So my take would be that you solve the NBFC sector problem on an urgent basis, let RBI continue cutting rates and keep liquidity flush in the system, and at the same time you maintain the fiscal prudence, which over a period of time will do better for the economy, and you'd see growth coming back to 6% handle, at least if not 7% over the next 3-4 quarters.
Rahul, is there some signs that there is improvement in the transmission process a little bit? I asked because, the short-term rates in the money markets are down. Deposit rates have been cut by banks. Should we then expect that some of the past actions, and if they continue with the rate cutting action, would have some positive impact, at least in Q3 and Q4 maybe?
No, I think the transmission is going to improve going forward. I mean, we have seen, at least as far as the marginal lending rates are concerned, they have declined by roughly about 40 basis points since the start of the cutting cycle. I think the RBI has, taken some initiative to kind of explain as to why transmission has been slower this time round. And our sense is that over the next 6 months or so, transmission will definitely pick up. We will also see, ongoing support. So both the short end and the long end of the curve should generally tend to, will be biased to move lower. I also want to just add one more point on the question that you had asked to Kaushik. I mean, I think there has been a very strong revealed preference for the government to front load spending. If you just look at where the government consumption numbers are. So in a way, they are running a counter-cyclical fiscal policy support for the last 3-4 months. In fact, the numbers that came out earlier today for the month of October, you can again see government spending being relatively high. And so there is this front loading of expenditure going on. Now, the clear question, as Kaushik rightly said, is that if in an environment where there is nominal growth slowing down, you have fiscal pressures, you have funding pressures, how do you, then come out of this situation where you're managing the rating agencies and you're trying to, manage a slowdown? Our sense is the revealed preference is fairly strongly towards reviving growth. I think ultimately, as a friend of mine said, growth does solve a lot of issues in some sense, and so I think the focus seems to be right now on addressing the growth problem more than the sustainability issue.
All right, gentlemen, I'll leave it at that. Thank you so much for taking the time to speak to us. Appreciate your thoughts and comments here on BloombergQuint. I'm now welcoming in Ashima Goyal, member of the Prime Minister's Economic Advisory Council. Ma'am, thank you so much for taking the time to speak to us. Let me ask you for your thoughts both on the real GDP number but also on the nominal number, ma'am, which is very low for Indian standards.
Right. But one point I wanted to make was that the estimates have come in line with what we were expecting from high frequency data. And even in Q1, most analysts who work with high frequency data had predicted a higher growth than we actually got, than the 5% we actually got. So it suggests that there is a stabilization. All this issue about GDP estimation, is it correctly estimated? Is the economy is actually growing at 4.5? It's not growing at 3% or anything, right? Because the data which the CSO is giving us is in line with high frequency estimates. So the issue of nominal GDP being so low, I think as a country we have to get used to, we move towards inflation targeting where inflation is to stay in a 2 to 6% range. So we have to get used to lower nominal growth figures, if it's going to be successful inflation targeting. Yeah. And that is the issue where, again, it shows clearly that you had demand decompression, very successful inflation targeting, but not sufficient with an overcorrection, And monetary policy was too tight. The real rate was still high, given the clear sort of first that, and then second, it was very clear after ILFS that the credit growth is tanking. So credit growth in H1 this year is only 12% of what it was in H1 last year. Then you obviously expect this kind of widespread slowdown. That time there should have been some kind of rescue package for, liquidity provision, which would have allowed NBFC credit growth to continue. We would not have seen this kind of tanking.
So to your mind, ma'am, this issue of rates, liquidity and the flow of credit to the real economy has a greater bearing on what's happening right now as opposed to the other theory or the other narrative, which is that there is a problem of wages and hence consumer demand.
Yeah, because wage growth didn't suddenly happen last year, no? Wage growth has been moderating for quite some time. Real agricultural growth, wage growth really grew rapidly in the period of very high food inflation. Earlier, it had always been sort of flat. Nominal wage growth would grow in line with the inflation, but real wage. So I think there was a sort of reaction because food is a large part of the consumption basket, and also there was a huge sort of lot of money being pumped into rural construction and so on, government money, and so there was a real wage growth. But that has slowed for a long time now as policy was tightened, the fiscal deficit was tightened, and so on. And then why should that wage growth, slow wage growth, suddenly lead to a decrease in consumption last year? But this decrease happened absolutely after the NBFC and this, because banks are already very cautious and risk averse because of the NPA issue and so on.
Sure.
And then NBFC happened last year in 2018 after, so then credit slowed and the liquidity packages that the government prepared were all working through banks who were not willing to lend that much, so they didn't work too well. And that is why, lender of last resort function is so important because it has to be done quickly. You have to quickly reassure market, or there's accumulative cycles of contraction,
Sure.
as what is just an illiquidity problem becomes insolvency. There are asset sales at distressed values, which affects balance sheet, which affects spending, which affects others. So we've been seeing that cumulative cycle working through the economy.
Sure. Ma'am, two questions. One on the fiscal side. Do you see merit in the argument that the government needs to do more? I say that recognizing that there's been a significant jump up in government spending in this quarter as reflected in the GDP data. But on the flip side, the problem is that if nominal GDP is lower than that 11-12% which was used in the budget, then you have a fiscal problem, just on the basis of data more than anything else.
Right, but this is what you expect, that tax revenue will slow down when growth slows and nominal GDP, also inflation falls. And but then even the FRBM, which is a very stiff, very conservative report, that also allows, has an escape clause that if growth fall is more than 3% in one quarter, then fiscal deficit can rise 0.5. And this government is so committed to reining in the deficit and following that path, they have really not stimulated the economy enough because of that. We've had very conservative and tight fiscal as well as monetary policy ever since 2011, I think, after we had the double deficit problem and so on. So I think that they are going to make sure that the increase in the deficit is not more than this 0.5. They're aggressively pursuing privatization, other ways of raising revenue, finding slack in the system, etc. So therefore, I think then what is happening internationally is that the bond market vigilantes have suddenly reversed. Now they're all saying that the central bank stimulus is not adequate, the world is slow, global growth is slowing, and government can borrow at such low rates. They should borrow and there should be more fiscal spending. The debt which, say, the advanced economies have, US and so on, is many times what our debt. And we have higher, when people say we are still growing at 4.5%, still positive growth, most advanced economies won't grow at in 2 or 3% if they're lucky. So then what happens is the denominator rises, the deficit ratio falls. That is why the government preponing spending and maintaining, especially capital spending or productive spending, is so important, because we are seeing in the figures that the only thing that's supporting growth really is public administration and so on, right?
Right.
So they can't afford to sort of stop spending over the next quarter in order to meet some artificial fiscal deficit.
So you do think they'll take that escape clause route of 0.5%?
Yeah, but 0.5 is not a very large increase in the circumstances.
True. Ma'am, one last question on monetary policy. You already alluded to real rates continuing to be high. This is a question to you as an economist. Do you have a sense of what is an appropriate real rate in such a cycle for India? Because, the Reserve Bank of India had some benchmark which they now don't really look at. They looked at during Dr. Rajan's time, but, since then they haven't been giving us that indicator. So it's very tough for the markets to judge, where the floor is on rates, because you don't know what kind of real rates are seen as appropriate.
Yeah, so I like to look at the 1 year ahead treasury bond because it's forward looking, right? So your expected inflation. I think inflation is not going to be more than 4% because core and so on is very low. And the real rate just now works out to about 0.8. While Rajan and so on used to refer to a real rate of 1.25, but that is a steady state. When you have this kind of a slowdown, then real rates need to come down. I also like to look at it in, after the global financial crisis, we had a cut in nominal rates of about 4.75 and real rates were sharply negative. And you had a huge fiscal stimulus, 4%. And this counter-cyclical policy really stimulated growth. Growth shot up from 6.7 to 11%. They didn't even know it was growing that fast because the data was revised later. But today, we don't want that kind of overreaction. And then there was overreaction of over-tightening all these years. So now I think we need a nominal cut of at least 2%. Real rate can be positive, but it should, mean 0.5 is all right in the circumstances.
Okay.
So, because depending on what inflation you're looking at, the real rate is very different. Although headline inflation has gone up, it's probably transient because of food prices, these floods and so on. core inflation, WPI inflation is 0.5. That means a very high real rate, which is what faces firms. And then also because we have large spreads in our system. So there's an argument that these spreads, etc., are so high, there's very poor monetary transmission. But there's a counter argument that monetary policy should cut more because there's such high spreads so that, the transmission is there. So I think we have to act on the different kinds of the term premium, the risk aversion, which is raising spreads in corporate bonds. They can act on all that as well as bank transmission, but they can begin by cutting their repo rate.
All right, ma'am. I'll leave it at that. Thank you so much for taking the time to speak to us. That's Dr. Ashima Goyal, member of the PMEAC. That's all the time we have on this broadcast. Do go to BloombergQuint.com to read more about today's GDP release.
So people, when they invest and the